Welcome. Just today we are going to discuss a new chapter. The name of our book is Accounting Principles. Uh, Writers Wagan, Kimmel and Kaiso. And this is 12th edition book. Today's chapter, Accounting for Receivables. This is very important. And including these chapters, we have 4 learning objectives. Objective number 1, explain how companies recognize accounts receivable. This is one. Number second, describe how companies value accounts receivables and record their disposition. Number three, explain how companies recognize notes receivables. Number four, describe how companies value notes receivable, record their disposition and present and analyze receivables. Okay, move to next. Learning objectives on explain how companies recognize accounts receivables. Amounts due from individuals and other companies that are expected to be collected in cash. That means amounts due when we sell our goods on credit. That times any individuals or companies, they can purchase our goods, and the others companies, they can purchase our goods, and this amount expected to be collected in cash. That's why here we have 3 matters: amounts owned by customers on accounts that result from the sale of goods and service. Number 1. Number 2, written promise for amounts to be received normally requires the collection of interest. Here example, interest. Number 3, non-trade receivables such as interest, loans to officers, advances to employees, and income tax. Next, we call this is the account receivable, this is the note receivable, this is the other receivables. Okay, and now types of receivable, we are continuing. Amounts due from individuals and other companies that are expected to be collected in cash. That means this is the receivables as a percentage of total assets. Receivables as a percentage of total assets. Company, here we have company 1, 2, 3, 4, 5. This is the receivables as a percentage of assets, and this is the percentage. Types of receivable, three accounting issues: recognizing accounts receivable, valuing account receivable, disposing account receivable. In recognizing account receivable, service organization records a receivable when it performs receipts on account. Okay, service organization records a receivable when it performs service on account. Number second, merchandiser records account receivable at the point of sales of merchandise on accounts. Recognizing account receivable, just we can show an example. Just illustration. Assume that Jordan's company on July 1, 2017 sells merchandise on account to Polo company. That means Polo company is purchaser, George's seller. Sells merchandise on account to Polo company for $1,000 terms 210 net 30. Prepare the journal entry to record these transactions on the books of George's company. So July 1, account receivable $1,000, sales revenue $1,000. Journal entry, record these transactions on the books of George's company, and this is on accounts or on credit. So journal entry will be account receivable debit and sales revenue credit. And on July 5, and this transaction July 1, please look here, notice this matter, July 1, and this is the July 5, July 5, the Polo returns merchandise worth $100 to George's company. That means the Polo returns to George's company. So here account receivable must be reduced, so account receivable must be credit, and sale returns and allowance will be debit. And on July 11, George's receives payment from Polo company for the balance due. So here please look here, 210 net 30, 210 net 30, this is very important matter. 210 means that means July 1, July 1, suppose July 1 the selling date, and if the Apollo company pay all amount to George's company 210 n 30, 210, that means within 10 days, within 10 days, that means the Apollo company will get some benefits, that means 2% benefits, 2% benefit. If they fail to pay this amount, then N30, that means within 30 days, the Polo company must pay to the George's company, and for this N30, the Polo company will not get any benefit. So here this is the point. George's company receive payment from Polo company July 11. So the Polo company will get some benefits here. So here 2% benefits, 2% benefits, that means now amount 900, that means 1000 minus this 100, so $900, 900, 2%, 18 taka. So we call this is the sales discount, this is the loss by the George's company, by the George's company. So here account receivable must be 900, and the George's company will receive $882, and sale discount, this is 18 taka, this is loss. But on the other hand, the Polo company benefits and the George's company loss. Do it. Very simple example. On May 1, Wilton sold merchandise on account to bets for $50,000, term 315 net 45. That means if they pay within 15 days, they will get 3% discount. On May 4, bets return merchandise with a sale price $2,000 return, and May 16, and here May 1 and May 16, 15 days. This is the 315, terms 315. You know, within 15 days, if the bets company pay to the Wilton company, the bets company will get 3% benefits, and Wilton receive payment from the bets on the balance due. Prepare journal entries to record the May transactions in Wilton books. Account receivable bets, this is sales revenue 50,000, and returned 2,000, this 2,000 return, please look here. And cash means 48,000, 3%, so this could be 1,440. So account receivable 48,000, and cash received by the Wilton will get this amount, and Wilton just as a loss amount, this, that means this is the sale discount. Promptly collection the amount. Sometimes the seller offers some financial benefits. I think everybody is clear here. Thank you so much.